I'll show you the Bronx. Bobby Bonilla famously said that to a Mets beat reporter in 1992 as a way of demonstrating the toughness he had learned in city streets. Bobby clearly learned a thing or two about financial analysis in his childhood days in the Booty Down Brun IXXX. As well, I am writing this column just on the other side of the Whitestone Bridge, which connects the Bronx and Queens, and only a mile or so from the home field of the New York Mets. City Field. A little local knowledge is helpful, and it is also a reminder that today, July 1st, is Bobby Bonilla Day. In 2000, the Mets wanted to rid themselves of Bonilla and his $5.9 million salary, so they agreed to a deal that would pay him that $5.9 million with an imputed interest rate of 8% over 25 annual payments each July 1st, beginning in 2011 and ending in 2035. From the New York Post. The 10th annual Bobby Bonilla Day is upon us, during which the 57-year-old former outfielder who retired from baseball in 2001 will collect a check for $1,193,248.20 from the team he disappointed during two separate stints. The Mets owed Bonilla $5.9 million when they released him after the 1999 season, and agreed to defer the payments through 2035 at 8% interest, largely because the Wilpons had been told their account with Madoff would produce annual profits of at least 10%. Bonilla's decision to accept deferred compensation from the Mets teaches us two important investing lessons. Locking in above market yields has been a value-creating strategy for the past 35 years as U.S. Treasury note yields have steadily declined during that period. Chasing manager performance and ignoring volatility is the worst mistake an equity investor can make. If the Wilpons were not such buffoons, they would have understood that no one could produce double-digit gains in all market environments, as Bernie Madoff had fraudulently claimed to be able to do. So Bobby Bonilla Day is an annual reminder of the infinite wisdom of the power-hitting third baseman/outfielder and the colossal stupidity of his former employers. In agreeing to defer the money he was owed, Bobby and his agent, Dennis Gilbert, were implicitly betting that long-term interest rates would decline, as this chart from the St. Louis Fed database indicates. That bet has paid off for more than a generation. Stock investors, and I am one, have moments of market timing remorse, but there has been no such volatility in the market for long-term bonds. There are no crashes, and there aren't even in any chart movements that resemble peaks and valleys. It has been a one-way trade since 1985. So that's nirvana for a bond investor. Fixed income investors, and Bobby implicitly is one, are getting capital gains as well as high coupons, as the market reprices existing higher coupon fixed income securities to account for lower current interest rates. The biggest risk Bobby was taking was that interest rates would skyrocket between 2000, when the deal was agreed, and 2011. That would have lowered the implied principal value of Bobby's bond, but in fact, just the opposite occurred. In April 2000, just before the start of that baseball season, the 10-year U.S. Treasury note was yielding 6.23%. In April 2011, that figure was 3.32%. So Bobby made a wonderful trade and missed out on the 2008 to 2009 stock market implosion and the 2001 tech bubble burst. To boot, the U.S. government has never missed a payment on a security, and despite their problems with Madoff, the Wilpons and the Mets, to my knowledge, have never missed one either. But wait, couldn't Bobby have taken the $5.9 million as a lump sum in 2000, put it all in Amazon AMZ and shares, and have hundreds of millions of dollars now? No. In April 2000, Amazon was trading at $67, and in April 2011, Amazon was trading at about $180. Amazon has never paid a dividend.